Warren Buffett called derivatives financial weapons of mass destruction in 2003. He was right. In 2008, a $60 trillion derivatives market nearly destroyed global civilization, requiring $29 trillion in emergency bailouts, more than the entire GDP of the United States at the time. Today, that market is $600 trillion, 10 times larger. Four American banks are holding $186 trillion in derivatives exposure. That's twice the entire global economy sitting on the balance sheets of four institutions. JP Morgan Chase alone holds $54 trillion, more than half the U.S. economy in one bank's derivatives book. When this explodes, there won't be enough money in the world to bail them out. The U.S. government is $36 trillion in debt. The Federal Reserve's balance sheet is already $7 trillion from previous interventions. Basic arithmetic proves they cannot stop what's coming. This isn't speculation. This is mathematical inevitability. Let me show you exactly why. Derivatives are bets on bets. They're financial contracts whose value depends on something else: interest rates, stock prices, currencies, commodities. A bank makes a bet that interest rates will rise. Another bank takes the opposite side. Both sides put down a small amount of money, but they're exposed to massive gains or losses based on what happens. They exist to hedge risk. A farmer wants to lock in grain prices. An airline wants to lock in fuel costs. Derivatives let them do that. But banks turned hedging into speculation. They turned risk management into a casino. Here's what makes them dangerous: leverage. You put down $1, you're exposed to $100 in losses. That small market disruption creates catastrophic losses that exceed all the capital in the banking system. In 2008, derivatives on mortgage-backed securities collapsed. Banks had bet trillions that housing prices would keep rising. When they fell, the losses cascaded through the system. AIG, the world's largest insurer, had sold $500 billion in credit default swaps, insurance on mortgage bonds. When those bonds failed, AIG owed money it didn't have. The company would have collapsed in 72 hours without a $182 billion government bailout. That was $60 trillion in total derivatives exposure. Today, it's $600 trillion. Now let me show you why it's about to break. To understand why $600 trillion will crash everything, you need to understand what $60 trillion did in 2008. Lehman Brothers held $35 trillion in derivatives exposure, 50 times its actual capital. When mortgage bonds started failing in 2007, Lehman faced margin calls it couldn't meet. Counterparties demanded collateral. Lehman didn't have it. On September 15, 2008, Lehman Brothers declared bankruptcy with $639 billion in assets, the largest bankruptcy in American history. But here's the critical detail most people miss. Lehman wasn't just one failing bank. It was a counterparty to thousands of other institutions through derivatives contracts. When Lehman failed, it triggered a cascade. Banks that had sold credit default swaps to Lehman suddenly faced losses. Money market funds that held Lehman debt broke the buck. Their share value fell below $1, causing panic withdrawals. The Reserve Primary Fund, a $62 billion money market fund, collapsed, triggering runs on other funds. Credit markets froze completely. Banks stopped lending to each other because no one knew who was exposed to Lehman, who was exposed to institutions exposed to Lehman, and how deep the contamination went. The TED spread, the difference between what banks charge each other versus what the government pays, spiked to 4.65%, the highest ever recorded. Translation: banks trusted the government more than they trusted each other. General Electric couldn't roll over its commercial paper. The company that built jet engines and power plants nearly failed because it couldn't access short-term credit. Ford and GM faced bankruptcy not because no one wanted cars, but because the credit markets that financed dealerships had disappeared. Within weeks, $10 trillion in stock market wealth vanished. 8 million Americans lost their jobs. 5 million families lost their homes to foreclosure. The Federal Reserve dropped interest rates to zero. Congress passed the $700 billion TARP bailout. The Fed created $3.5 trillion through quantitative easing, buying assets to inject liquidity. Global central banks coordinated $29 trillion in total interventions, loans, guarantees, asset purchases. That's what it took to stop a $60 trillion derivatives market from collapsing civilization. And it barely worked. We came within hours of ATMs shutting down, of credit cards not functioning, of the payments system failing completely. That was for a market one-tenth the current size. The derivatives market has grown from $60 trillion in 2008 to $600 trillion today. But it's not just 10 times bigger. It's structurally more dangerous in three critical ways. In 2008, derivatives were spread across dozens of major banks globally. Today, in the United States, four banks hold $186 trillion in derivatives exposure. JP Morgan Chase, $54 trillion, Citibank, $46 trillion, Goldman Sachs, $44 trillion, Bank of America, $42 trillion. That's 86% of all U.S. derivatives concentrated in four institutions. JP Morgan's derivatives book alone is 2.6 times the entire U.S. GDP of $28 trillion. If JP Morgan fails, it triggers cascade failures at every institution that's a counterparty to JP Morgan's contracts. Those failures trigger the next layer of counterparties. The system is more interconnected and more concentrated than 2008. The leverage is higher. The dominoes are stacked taller. Interest rate derivatives account for $490 trillion of the $600 trillion total. These are bets on where interest rates will go. When rates move, one side wins, one side loses. From March 2022 to July 2023, the Federal Reserve raised interest rates from 0.25% to 5.25%, the fastest rate increase cycle in 40 years. Every 0.25% increase created winners and losers in the derivatives market. The losers are holding unrealized losses right now. We know this because banks are required to report these positions to the Office of the Comptroller of the Currency. As of Q2 2024, FDIC-insured banks held $515 billion in unrealized losses on securities portfolios, bonds and derivatives positions that haven't been marked to market yet. Translation: the bombs are already planted. They just haven't detonated yet. Banks are using accounting rules that let them classify derivatives as held to maturity, avoiding the requirement to show current market values. The losses exist. They're just hidden. When Silicon Valley Bank failed in March 2023, it held $21 billion in unrealized losses on treasury bonds, supposedly the safest assets in the world. When depositors panicked and withdrew money, SVB had to sell those bonds at a loss. The bank failed in 48 hours. Silicon Valley Bank held zero derivatives exposure. It failed on treasury bonds alone. Now imagine what happens when banks with trillions in derivatives face the same dynamic. After 2008, regulators promised to fix the system. The Dodd-Frank Act required derivatives to be cleared through central clearinghouses, making the system more transparent. But here's what actually happened. Congress and regulators exempted 90% of derivatives from the clearing requirement. Interest rate swaps between large banks? Exempt. Foreign exchange derivatives? Mostly exempt. The very products that pose systemic risk were carved out of the rules. The Volcker Rule was supposed to ban banks from proprietary trading, making risky bets with depositor money. But the rule was weakened so heavily that banks can still trade derivatives classified as hedging or market making, which is nearly all of them. Capital requirements increased marginally. Under Basel III rules, banks must hold more capital against risky assets. But derivatives receive favorable treatment in risk-weighting formulas. A bank can hold $50 trillion in derivatives and be considered well-capitalized under regulatory definitions because the models assume positions are hedged. The assumption is nonsense. In a crisis, correlations go to 1. Everything moves in the same direction. Hedges fail. Counterparties default. The models become fiction. The safety mechanisms don't exist. The exposure is bigger. The concentration is tighter. And this time, there's no bailout capacity left. 3 specific catalysts could detonate this system. They're not theoretical. They're active right now. Trigger 1. Interest rate volatility. The Federal Reserve has executed the most violent interest rate policy in 40 years. From near zero in 2021 to 5.25% in 2023, then holding rates high while inflation cooled. Now facing pressure to cut as recession risks build. Every rate change creates winners and losers in the $490 trillion interest rate derivatives market. If the economy enters recession and the Fed cuts rates aggressively, say, back to 1% or 0, Different institutions face catastrophic losses on positions that bet rates would stay high. But if inflation resurges and the Fed has to raise rates again, the institutions currently holding losing positions face even worse losses. Either scenario creates crisis. But if the Fed flip-flops, cutting, then raising, then cutting again, the whiplash volatility alone exceeds what risk models predicted. That triggers margin calls. When your position loses value, your counterparty demands more collateral. If you can't post collateral, you're in default. Default triggers liquidation of all your positions, which moves markets further, which triggers more margin calls at other institutions. Cascade. This isn't speculation. In September 2022, UK pension funds faced a derivatives crisis that nearly collapsed the British financial system. They had used interest rate derivatives to hedge liabilities. When UK government bond yields spiked after a disastrous budget announcement, pension funds faced £1 trillion in margin calls they couldn't meet. The Bank of England had to intervene with emergency bond purchases, reversing its inflation-fighting policy to prevent systemic failure. That was the UK, a $3 trillion economy. Now imagine the same dynamic in a $28 trillion economy with 10 times the derivatives exposure. Trigger 2. Sovereign debt crisis. U.S. federal debt is $36 trillion and rising $2 trillion per year. Interest payments alone cost $1.2 trillion annually, more than defense spending, more than Medicare. Debt to GDP is 125%, the highest since World War II. Foreign holders are dumping treasuries. China reduced its holdings from $1.3 trillion in 2013 to $770 billion in 2024. Japan, historically the largest foreign holder, has been selling to defend the yen. When foreign demand drops, yields rise. Higher yields mean the government pays more interest, which increases the deficit, which requires more borrowing, which pushes yields higher. A debt spiral. Banks are among the largest holders of treasury bonds. When yields rise, bond prices fall. Banks face mark-to-market losses on their treasury portfolios, the same dynamic that killed Silicon Valley Bank. But here's the derivatives connection. Credit default swaps on U.S. Treasuries have spiked. These are insurance contracts that pay out if the U.S. government defaults. In 2008, CDS on Treasuries traded at 10 basis points, $10,000 annually, to insure $10 million in bonds. By late 2023, they hit 70 basis points, the highest since the 2011 debt ceiling crisis. The market is pricing in default risk. Even a technical default, a brief delay in interest payments during a debt ceiling fight, would trigger CDS contracts worth trillions of dollars. Banks that sold that insurance would owe money they don't have. Cascade. And if there's an actual sovereign debt crisis, if investors lose confidence in U.S. Treasuries as a safe asset, the entire financial system collapses. Treasuries are the collateral backing derivatives contracts. They're the risk-free asset in every risk model. If treasuries aren't safe, nothing is priced correctly. Every model breaks. Every hedge fails. Trigger 3. Commercial real estate collapse. Commercial real estate is imploding. Office buildings sit 30 to 50% empty as remote work persists. Retail space has been decimated by e-commerce. Regional banks hold $2.3 trillion in commercial real estate loans, 40% of their total loan portfolios. Values are down 30 to 40% since 2022. Loans made when properties were worth $100 million are now backed by properties worth $60 million. But those loans haven't been written down yet. Banks are extending maturities, pretending properties will recover value, avoiding recognizing losses. This is the same extend and pretend that preceded the 2008 mortgage crisis. It doesn't work. When loans mature and can't be refinanced, properties go into foreclosure. Banks take losses. Capital evaporates. Banks fail. In March 2023, First Republic Bank failed with $176 billion in assets, the second largest bank failure in U.S. history. The cause? Commercial real estate exposure and uninsured deposits fleeing after Silicon Valley Bank collapsed. First Republic held minimal derivatives exposure. It failed on real estate and deposit flight alone. Now consider, regional banks with trillions in commercial real estate exposure also hold derivatives positions. When real estate losses consume capital, those banks can't meet margin calls on derivatives. Default. Cascade. The triggers aren't theoretical. They're active. Interest rate volatility is producing hidden losses right now. Sovereign debt risk is rising. Commercial real estate is failing. Any one of these could be the spark. All three are building simultaneously. In 2008, governments could bail out the system because they had capacity. U.S. federal debt was 67% of GDP. The Federal Reserve's balance sheet was $800 billion. There was room to print money, buy assets, inject liquidity, and guarantee everything that moved. In 2025, that capacity doesn't exist. U.S. federal debt is $36 trillion, 125% of GDP. The government pays $1.2 trillion annually just in interest. 16% of all tax revenue goes to service debt. They're not a savior. They're the biggest debtor in the system, one crisis away from their own sovereign debt spiral. The Federal Reserve's balance sheet is $7 trillion from COVID-era interventions. When they printed $4.5 trillion in 2020 to 2021, it caused 9% inflation, the highest in 40 years. They spent the next 2 years raising rates to fight that inflation. They can't do it again without destroying the dollar's purchasing power and triggering a currency crisis. Here's the math that doesn't work. If $600 trillion in derivatives start cascading, and even 5% go bad, that's $30 trillion in losses. There isn't $30 trillion available. Not from the federal, not from the Treasury, not from foreign central banks who are already dumping U.S. treasuries to defend their own currencies. In 2008, the bailout worked because the system was still fundamentally solvent. Banks were illiquid, they couldn't access cash, but their assets exceeded liabilities if you waited for markets to recover. So the Fed lent against those assets at favorable terms, giving banks time to survive. It worked. In 2025, the system is insolvent, not just illiquid. The losses are real and permanent. You can't print enough money to make an insolvent institution solvent. You can only transfer the insolvency from the bank to the government to the currency itself. And when you destroy the currency, you destroy everything priced in that currency, which is everything. Foreign central banks won't help. In 2008, China had $2 trillion in reserves and bought U.S. assets to support the recovery. Today, China faces its own debt crisis, $50 trillion in total debt, including local government obligations. They're not buying, they're selling. Europe can't help. European banks hold their own massive derivatives exposure. Deutsche Bank alone holds 40 trillion euros. Europe is dealing with energy crisis, negative demographics, and sovereign debt problems across southern European countries. Japan can't help. Japan's debt to GDP is 260%, the highest in the developed world. They're trapped, unable to raise interest rates without bankrupting their own government. You can't print enough money without destroying the currency. You can't negotiate enough debt forgiveness to make insolvent banks solvent again. The mathematics simply doesn't work. The difference between 2008 and 2025 is capacity. In 2008, governments could theoretically bail everyone out. In 2025, they cannot. That's not opinion. That's arithmetic. What comes after the derivatives market explodes is unknowable because we've never seen a financial crisis on this scale. The Great Depression unfolded over years, giving people time to adjust. A derivatives cascade would unfold in days or weeks, moving faster than policy could respond. Here's the sequence based on 2008, but accelerated. A major bank, say JP Morgan, with $54 trillion in derivatives exposure, announces losses exceeding capital. Maybe it's interest rate positions. Maybe it's exposure to a sovereign debt crisis. Maybe it's a counterparty default that triggers margin calls they can't meet. The cause doesn't matter. The bank is insolvent. Stock crashes 90% in a day. Trading halts. Credit default swaps on JP Morgan trigger, requiring counterparties to pay out. Those counterparties face sudden, massive obligations. They can't pay. They default. Their counterparties face the same cascade. Within 48 hours, multiple institutions are insolvent. Bank of America, Citibank, Goldman Sachs, all are interconnected through derivatives chains. When one goes, they all go. Credit markets freeze completely. Banks stop lending to each other because no one knows who's exposed. Money market funds face redemptions. Commercial paper markets cease. Businesses can't make payroll because their credit lines evaporate overnight. Supply chains break. Trucking companies can't buy fuel without credit. Manufacturers can't pay suppliers. Retailers can't stock shelves. Within days, shortages appear. Not because there's no production, but because the financial system that coordinates production has failed. Bank accounts freeze as institutions go into receivership. The FDIC insures $250,000 per depositor, but with only $125 billion in the insurance fund. When multiple trillion-dollar banks fail simultaneously, the FDIC is insolvent. Depositors can't access their money. ATMs stop working. Credit cards decline. Cash becomes the only medium of exchange, but there isn't enough physical currency for an economy that's 97% digital. Pension funds show losses so catastrophic that retirement becomes impossible for millions. Defined benefit plans were already underfunded by $1.3 trillion before the crisis. After a $600 trillion derivatives collapse crashes the stock and bond markets, those plans face 50 to 70% losses. Unemployment spikes to 15 to 20% within months as businesses fail without access to credit. Not because they're unprofitable, but because the financial system that enables business operations has ceased functioning. The stock market crashes 60 to 80%. Not over years, over weeks. The S&P 500 at 3,000 fell to 666 in 2009, a 54% decline that took 18 months. This time it falls 70% in 60 days. $30 trillion in stock market wealth vanishes. Retirement accounts, 529 college savings plans, brokerage accounts, all destroyed. Real estate crashes 40 to 50% as foreclosures cascade. Commercial real estate falls even further, 60-70%, as properties become stranded assets with no financing available for buyers. Housing prices collapse as unemployment surges and credit disappears. Mortgage defaults spike. Banks foreclose, flooding the market with inventory, pushing prices lower. Homeowners with mortgages are underwater. Those who try to sell can't. The market freezes. This isn't prophecy. This is following the chain of consequences when a $600 trillion market collapses with no bailout capacity left and no policy tools that can address losses on this scale. A market that was $60 trillion nearly destroyed the global economy in 2008 despite $29 trillion in emergency interventions. That market is now $600 trillion, 10 times larger. The concentration is worse. For banks holding $186 trillion. JP Morgan alone holding $54 trillion. The triggers are visible. Interest rate volatility is creating hidden losses. Sovereign debt risk is rising. Commercial real estate is collapsing. All three are active simultaneously. The policy tools are exhausted. No capacity for bailouts with $36 trillion in federal debt. No capacity for money printing with inflation still above target. No foreign central banks ready to help. This isn't prediction. It's pattern recognition. When Warren Buffett called derivatives financial weapons of mass destruction in 2003, the market was $100 trillion. He was right in 2008 when $60 trillion nearly collapsed civilization. The weapon is now 6 times larger than when he issued the warning. It's concentrated in 4 institutions, and the safety mechanisms don't exist. The pattern is clear. The math is unsustainable. The timeline is narrow. For those willing to see it.